Okay, all set. Hello everyone. I hope you all fine and doing great. I and myself Raja Arun Kumar. I take class for CMA Inter Group 2, paper number 10, Cost and Management Accounting and Financial Management. Today we start with the financial management subject in study note starts in study note 6. Okay, let me start. Yes, here introduction of financial management. Before we see the subject introduction of financial management, you just imagine you are the CEO or CFO or a financial head and the financial department head of the in popular we say Ambani company, Reliance head, Geo head, and you are the person, finance head person, CEO, CFO of that company. Because if you imagine that, then only you can able to understand what you doing in the practical subject. Yes, this is a practical subject. This is the most important practical subject for you, because CFM in finals or group 3 subject, this is the basics for you. So accordingly, you study the basic subject of financial management, you thorough in the practical knowledge. Okay, let me come to the topic. Introduction of financial management. They have some 5 topics in there: meaning, objective, scope of financial management, and sources of finance, introduction to financial market. Before seeing that, we start with what is finance. What is finance? Finance is called the science of money. Yes, the financial management, we deals with the money only. So that's why I'm telling before, you are the CEO, CFO, and financial head of the company. You think accordingly that. So that time only you are deciding the person, decision making person. So this practical subject, you think practically. This is not a theory part. This don't skip this chapter. Most of the students skip the study note 6 and study note 1 in the paper 10. So don't do that. This is the practical subject, so you must be concentrated in theory also. So we start with the first question: what is finance? In the what is finance is asked in many times in short notes also. You write the answer. Finance is called as the science of money. It studies the principle and the method of obtaining control of the money from those who have saved it, and of the administrate it by those whose control it passes. Then, in simple term, finance is defined as an activity concerned with the planning, organizing, controlling, and administrating of the funds used in the business. Sorry, I take a pen if you have a highlight, if you want. Where I study, if you don't know where I am studying. 1 minute. I connect with my pen. Okay. Now my cursor is there. Here I study. You see my cursor? Yes, my cursor is there. Here I am studying. Okay. In simple term, finance is defined as a activity concerned with the planning, raising, controlling, and administrating of the funds used in the business. Those finance is activity concerned with the raising and administrating of funds used in the business. So we conclude that finance is an activity planning it, raising it, controlling it, and administrating of the funds used in the business. Those finance the activity concerned with raising and administrating of funds used in the business. Then we start with the financial management meaning. Here we come to the financial management meaning. Financial management is a managerial activity which concerned with the planning, controlling of the firm's financial resources. Finance management is a managerial activity which concerned with the planning and controlling of the firm's financial resources. Here some definition are given in the books. You just go through it. I don't go sorry I don't repeat the same thing again and again. This financial management is a forecasting, planning, administrating, coordinating, controlling same activity, acquisition and application of financial resources of the undertaking, keeping with the financial objective. Same before we see and study the same definition also coming here. The definition said by the some authors, the two authors, they have been said different definitions. So just go read it these definitions also. We straightly go to the objectives. Objective of the financial management. What is the objective? There is a two objective only is there. Finance is a come to the business. After putting the money into the business, first thing every investor or a owner or a entrepreneur, everyone promoters or everyone concentrate on profit. Okay, first thing is profit. Second thing is wealth. If you earn a profit, after that you growth your wealth. These both activities is concerned in the financial management. This both is the main objective of also the financial management. Here we start with the financial management objectives. Here what the profit maximization and wealth maximization, the both are main objectives of the financial management. Here see the some meaning. Financial management, as the name suggests, is the management of finance. Is the management of finance. It deals with the planning and the monetizing of the funds required by the firms. Funds required by the firm. So there is only one thing which matter for the everyone right the owner to the promoter, and that is the money. Managing is the finance is nothing but managing of money. Here we see money is a core objective of the business. Core thing. Money is a core of the business. So that's why we study the financial management. Objective was two objectives: profit maximization and wealth maximization. Profit maximization, the main objective was profit at the measure to the efficiencies. Profit at the measure of efficiencies, and it serves as a protecting against risk, because profit is not comes year by year. Certain losses also came in the business. In that time, we not affected by the loss. We protected by our profit. The profit take it as a reserve, and it put also in the wealth also. That's why the main objective of the financial management, we earn profit maximization and wealth maximization. Then we see some argument against and favor of the profit maximization. Just go through it. This is a simple terms they used, so not just more than tough in that. So just go through it. In the books, it will ask in the 1 mark also. So just go through in the books. Wealth maximization, we see wealth maximization. Wealth maximization is a concern with the appropriate objective of an enterprises. When the firm maximizes the stockholders' wealth, the individual stockholder can use this wealth to maximize his individual utilities. Wealth maximization in the single substitute for a stockholder utilities. A stockholder wealth is shown by the, here the formula is used. Just see the formula. Stockholders' wealth equal to number of shares owned into current stock price per share higher than the stock price per share greater will be stockholders' wealth. You hear it right. Stockholders' wealth equal to number of shares owned into current stock price per share higher the stock price per share. The greater will be stockholders' wealth. Okay, this is the wealth maximization. Here some formula is given. So you read it that favor and against wealth maximization. Just go through it. It take the 1 mark also. More than that, there is no importance. Don't give that much of importance. Just read it, go through it, and understand the meaning only. Then scope of management accounting. This is a most important question in every exam. They ask in that. You must like that highlight it. In South India, we have highlighted it like this. So accordingly, you also highlight. Sorry, 1 minute. Okay. 1 minute. Sorry for the inconvenience. Yes. In South India, we have highlighted like this. Put a circle and a higher X mark, and that dot is there. Here we are important question. Do like this. So you also do mark it as an important question. This scope of a financial management is the most important question. Asked in just 4 marks or short answers we have expected in 3 marks also. In new pattern examination, the short questions are converted into 3 marks into 4 questions you want to attend it. They ask in the don't give option for that. In the financial management paper 10, there is no chance to ask theory questions. The most of the practical questions they ask. If chanceless, if you don't strong in that practical question, in case that you have any 1 mark 2 mark you want, you read the theories also, you take the mark accordingly. Scope of financial management. Don't mug up the theory subject. You understand and study practical knowledge. This is purely practical knowledge. So study accordingly. Okay. Financial management is today concerned with the entire financial management. Today concern entire government of activity and functions given below. The head of the finance is considered as importantly. CEO is the most organization. So the head of the company, as I said before, the CEO is the most important in the organization, most of the organization. Here the roles of the CEO we see. Why I said you as a CEO, CFO and financial head, here we see that. That CEO doing estimate the total requirement of funds for the given period. The given period, what are the requirement of funds? The estimation estimated by CEO of the company. Raise the funds through the various sources, both national and international, keeping in the mind the cost effectiveness. Then invest the funds in the both long-term as well as short-term capital needs. Investing also, the CEO doing the strategic role. He performs a strategic role, right? Estimating the total requirement of funds given the given period, Investment funds in the both long and as well as short-term capital needs, funds day-to-day working capital requirement of the business, collecting on the time from the debtor and paying to the creditor on the time. This on the time he make the strategic role and calculating the practical sum. We calculate that sums in future period also, day-to-day working capital management, how to do, then collection period and paying to creditor period. Also we do in the working capital management in study note 8, managing the funds and treasury operation, like that we different role doing by the CEO. These are the scope of financial management scopes. Also the paying the interest on borrowing, repaying the lenders on the due dates, like that more functions there, more scope for the financial management, like CEO, CFO. Then we come to the directly financial management place. You just read you just read it. Function financial management play the two basic roles. First one, the participation in the process of putting funds to the work within the business and control their productivity. The participation in the process of putting the funds to work within the business and to control their productivity. Two, the to identify the needs for the funds and settle the sources of which they may be obtained. To identify needs for the funds and select the sources from which they may be obtained. Accordingly, they settle the select the sources what they need the funds with them. Just the same as before we said, where we get the money and where we use it accordingly, the same topic, same meaning will be repeated in different manner. So keep in mind, we have financial manager have find that where the sources of funds we get, where are the different sources we get, and where we use it accordingly, and where how to use it. These all management is known as financial management. This is the simple term. The term will be used in different way, different topic to understand the subject in depth. Next, the relationship of a finance with the other business functions. Other business functions like business function of manufacturing undertaking. Manufacturing undertaking, what they are doing, you imagine that manufacturing unit, they have purchased the raw material, they have production via work in progress, and their production function is there. They have the distribution function is there, accounting function is there, human resource function is there, research and development for that product is there. These are the various function then doing in the manufacturing units. So finance is the function of the business function, means the function of that enterprises under the achieving the desired objective. The relationship of the finance is the all activity. These all activity, there must be a finance is the core of these all activities. There are some examples they given in the explanation. You just go through it. We comes to the important point in the subject. This is the important point. You just mark it. Sorry. Yes, this is the important point. Key decisions of financial management. Key decisions of financial management. The modern approach to the financial management. The modern approach to the financial management is concerned with the solution of major problems like investment functioning and the dividend decisions of the financial operation of the business enterprises. The functions of the financial management can be broadly classified into three categories. This is the main three categories in the financial management. Key decisions are three: investment decision, financing decision, dividend decision. These three decisions we study in this financial management subject. I say in the book, they give a elaborate explanation in the book. We say three questions. Investment decision. Before I start with financial decision, where we get the money? Where we get the money is known as financial decision. Then where we invest where to invest, sorry. Where to invest the money is known as investment decision. Then how much to 1 minute. How much to distribute among the shareholders is known as dividend decision. I simply say where to invest the money is known as investment decision, and where we get the money is known as financing decision. Dividend decision means how much to distribute the among the shareholders. This all question you answered answer it. That decision is known as these three key decisions, which means investment decision, financing decision, and dividend decisions. Here we see the investment decision is a capital budgeting, working capital management. Here we study in the study note 10, and working capital management study note 8. We study in that time. I recall it. The investment decision and financing decision is a cost of capital, capital structure, leverage analysis, and dividend decision is dividend policy, retained earnings. These all topics we covered in the for the future classes. Then these all are practical only. Practical sums we also do. Okay. Then you 1 minute, mouse is not working, sorry. Yes, then the investment decision, financial decision, and financing decision, and dividend decision, you just go through it. Then we go to functions of financial management. The functions of financial management, there are functions or functional area of financial management. There are determine of financial needs, determining the financial needs, determine the sources of funds, financial activity, optimize optimal capital structure, cost volume profit analysis, profit planning and control, fixed asset management, capital budgeting, corporate taxation, working capital management, dividend policies, acquisition and measures. These are same topic repeated once again and again. Then we straightly we go to sources of funds. Wait a second. Before we go to the sources of fund, the role of financial executive. The financial executive roles. Here we see the financial executive, the organization plays an important role in the company goals, policies, and financial success. Financial analysis and planning, investment decisions, financing and capital structure decisions, management of financial resources, risk management. These all key financial executive play the important role in the organization. So we can come to the sources of finance. In that sources of finance, we understand where the sources we get the money in the clearly and explanation manner like given in the study note 6. The business needs the finance mainly two purpose. The funds the long-term decision to funds the long-term decision to meet the working capital requirement. There is the two things. Business firm needs for finance mainly for two purposes: to fund the long-term decision to meet the working capital management. Financial needs of the business is categorized into three parts: long-term financial needs, medium-term financial needs, and short-term financial needs. Here they give the examples. Long-term sources are shares, debentures are long-terms, and medium terms are debentures, public deposits, bank and loans are overdraft. Short terms are trade credit and advance from the commercial banks, advance from the customers. These are the short term, medium term and long term sources. Here we get the funds from the three categories. Long terms, owners own in the different chart. In this chart, the book they have explained in owner's perspective and borrower's perspective. Owner's perspective, owner's fund for equity shareholder and borrower's fund debentures and bonds. Preference share capital here, term loan from institution, rupees loan, foreign currency loan. Retained earnings, term loan from bank, capital subsidies and incentives, venture capital facing, interest-free sales tax loan, asset debt securities, euro. These all are liabilities only, but it categorized as owners funds and borrowers funds. In long term, medium term there is a only preference share capital, and short term there is a owners not put any short term funds. The owners put only the long terms. In short term we get from the credit from the credit from traders and expenses creditor, trade credit, advance from the customer, short term provisions, bank advances, factoring, commercial papers, public deposits, interest, corporate deposits, like that. Here the short terms. In long term also, medium term also, debentures, bonds, public deposit, long from financial institutions. Here we conclude that scope of sources of finance. Here we finish that topic called sources of finance. Here just elaborate they given where are the sources of finance we get from them. Here they give some examples and explanation of that topic. You want just read in that book, just go through it. Then debentures, credit instrument, like that they have explained in detailed manner, so just go through it, not but in this new topic I will explain it. This lease financing is different from the hire purchase. This is not a hire purchase. Lease financing is leasing is an arrangement that provides for firms with the uses and control over the assets without buying and owning the same. It's a renting the assets. It in the form of renting assets is known as lease financing. In hire financing, the buyer get the asset, but they pay for it installment, and after paying all the installment, there is a no pending. The owner of the asset is the hire purchaser only. If here that case, the asset will be going for only rental purpose. The operating here the types of leasing is two category: operating or a services lease, financial leases. Operating services lease, I highlighted some. Operating and services leases are categorized by the following features. It is a short-term lease. The lease provided a contract in the less than the useful life of the asset. The lends to usually cancelled at the short notice by the lessee. The lease usually has been option of renewing the lease after the expiry of the lease period. You just go through it. Examples: computer, vehicle, data processing equipment, communication system, etc. are the operating and services leases. Then financial leases. Example: financial leases are commonly used for leasing land, building, machinery, fixed equipment, or the financial leasings. So you must be understand that what are the terms used in different areas. You must be understand. So that's only you can understand that in the field of financial management. Here the term loan comes. The term loan also long term, short term. Here we see in the next later stages in the chapter. International sources. International sources is just like a depository receipt and global depository receipt and American depository receipt, like that they given in the book. These three depository receipts are those who are other outside India, they get funds from India, like that they telling in the explaining. I also explain it. The deposit receipt means the instrument from the form of the depository receipt or a certificate created by the overseas depository bank outside India and issued to the non-resident investor, to the outside investor against the issuance of ordinary shares. This is the depository receipt. As the depository receipt are issued overseas capital market, that funds are issuer are available in the foreign currency, generally in US dollars. Then global depository of negotiable instrument, basically a bearer instrument which is traded freely in the international market, either in the stock exchange, over the counter, or among the qualified international buyers. They are denominated in a US dollar, represent shares issued in the local currencies. Like that they give the explanation in the depository receipts. Okay, just go through in this topic. We come to the important topic, that foreign currency convertible bonds. Foreign currency convertible bonds means bonds issued in the accordance with the relevant scheme and subscribed by a non-resident in the foreign currency and convertible into ordinary shares of the issuing the company in the any manner, either in the whole or in the part, on the basis of any equity related warranty attached to debt instruments. Okay, we concluded so fastly. What is the seed capital? Seed capital is the capital which seed capital is the capital the promoter have contributed the seed capital in the project. Like that, first promoter put the first money is known as the seed capital. That seed capital also that finance also given by the IFSC. They give 40 lakhs to the promoter. The seed capital assistance scheme also given by the IDBI up to 15 lakhs for the promoters. Other financial institutions, through the other financial institutions Short-term sources of financial working capital management is a trade credit. You just read in that BCom, MCom or 12 itself, you just go through in the topics also. Here they give a different explanation. Commercial papers varies between the 15 days to the 1 year. This the maturity period of the commercial paper varies between the 15 days to the 1 year. Then there is a issue international intercorporate deposit. Intercorporate deposit, I want to tell something that intercorporate deposit, you hear that new topic. This is the simply we say, 1 minute, the highlighter is not working. Okay, take pen. Okay. Intercorporate deposit, ICDS. Intercorporate deposits are, if in SAP, I take in SAP, the SAP, they have one topic, subtopic, bank payments like that. If we create that bank payment account and the bank receivable account and the deposit account, in that three category, the payment account, it will be subcategory into two parts. The payment is from whom the payment, for example, I am an X company and Y company is there. I want to pay to the Z company. That Z company, on that time, I don't have the funds. That the owner of X company, I asked to the Y company's owner, you must pay that money after the few days or next next quarter I pay that money. Promise of mine, the Y company pay the amount of the X company. In accounting term, we recorded as a bank payment. The X, the who paid the Y paid the amount for the X company, for the X company. Like that, in the SAP, we do that practical thing we recorded in that SAP tool. Okay. In the intercorporate deposit concept is also same like that. I am an X company. Y company is my competitor or a friend, coordinate company also. I know that company very well. The promoter was my friend. In that case, I asked the promoter, give some amount to that Z company, and after that I pay that X and Y. That money was repaid after the quarter or a year or whenever she or she want. I pay reback the money. This is the general and liberal meaning of the intercorporate deposits. Then short-term unsecured debentures are unsecured. Debentures are unsecured. They're like that. We can also unsecured debentures loans also we get in the company. There is no security. The money is not secured after the getting the company. Like that, they give unsecured loan or debentures. Then bank credit, as you all know, the bank credits and the types of bank credits are overdraft, cash credit, bills receivable and bills discounting, letter of credit, working capital term loan, funded interest and term loan. Like that, we cover the most of the topic. Venture capital. Venture capital is a capital. The term venture capital represent, this is an interesting topic. You just read it. Venture capital. The term venture capital represent the financial investment is highly risk project with the objective of earning highly rate of return. The risk is high in the financial or investment investors. The risk is high, the return also high. In that time, they all investors thinking that venture capital is the best idea. Venture capital, the high risk in project, the project is successful, the return also successful, because the venture cap when the modes of the financial by the finance by the venture capital is three modes: equity, conditional loan, and convertible loans. Equities are venture capital funds provided the financial support the entrepreneur, the form of the equity by the financing 49% of equity total equities. This is the ensure that ownership and overall control remains with the entrepreneur only. Then conditional loan is that venture capital put some conditional also point of view, secured debt instrument like that. He put some condition also. Convertible loan is that other loan which may be convertible into equity if interest payment are not made within a agreed time limit. The loan with be convertible. The loan is convertible into equities, because if the interest payment is not made within the agreed time limit, the loans are convertible into equities. So accordingly, you pay the dividend also. So the convertible loans also given by the venture capital. These are the three topics. And other financial service like hire purchase, as I said that hire purchase and leasing is different. Here hire purchase is a transaction with the goods are purchased and sold. This here comes the goods. There we study that assets only. Goods and purchase sold, the term that the payment is made in the installment basis. Then factoring, the new topics are small topic, you just go through it in the books. In the time concern, I skip these topics. They give the detailed explanation of that. Factoring is that the person who seller of the firm, first they sell the goods to factor. The factor collect the payment from the due date from the customer and receivable, and after that we invoices. Sorry, first we sell the goods to the factor. Invoice copy sent to the factor. Then factor advance payment to the seller, the firm. If the firm needs the funds, then needs the funds advance payment to the from the factor. Then customer and receivables are payment on the due date. Then factor pay the final payment in the end. This is the factoring examples. These some basics they give the some explanation in that. Then we straightly go to topic number 5, that is introduction of financial market. In this topic, a financial market is a market where the financial instrument are exchanged or a trade. Financial markets provided the following three major economic functions: price discovery, liquidity, reduction in transaction cost. Financial market, these three category major economic functions. Three major economic functions. Just go through in the book. Because of the time concern, I conclude these classes the few minutes, and then the theory part is telling the same thing again and again. You just clarity and study the theory part. The one day you study, take a morning 4 to 8 o'clock. You just go through the each and every part and write it hint note accordingly. You take some notes in that I highlighted the video. You also take some highlighted points also in the notes you take. This is helpful to your examination. So accordingly you take that. Then functions of finance market. There is a finance market classified into money market and capital market. Money market is primary capital market and secondary capital market. This is the out of syllabus. These topics are not related to that finance management subject in paper number 10. This is helpful to the strategic financial management in group 3 final level. You just go through these topics. This is the basic topic for that final level. You just go through it. conclude the class with the one new format, and then capital market is subdivided into four category: uh, equity shares, debentures, preference shares, and sweat equity shares. Like that, they are subcategories into. Then there is, and then Foreign Exchange Management Act. This is also Companies Act, paper number 13. They have a separate topic is there. This is a brief introduction for that topic. While obtaining the finance from the foreign sources, finance manager must keep in the mind the provision related to finance management must be observed. Provisions related to FEMA, Foreign Exchange Management Act must be observed. A strict adherence to the provision of section 3 to 8 of the FEMA is mandatory. Similarly, while doing the international trade, import or export, relating to Custom Act also be adhered. So that everything the financial management see the law also. According to that law, he follow the financial management decision. Then here sum is there, that time value, compounding, and discounting. This is a simple sum explained in the book. Just go do it the sum. Before that, I make a blank board. I share a whiteboard. Once again, here I take a text. Yes, here it is. This is the just go. You just copy and pay. You just copy it. The statement of income. This is the basics for your further classes. I take the next class start with the leverage analysis. Before you go to the leverage analysis, we must understand that what is EBT, EAT. One minute. EBT, EBT. Yes. What is EBIT and EBT, EAT, EAES, like that? You must be understand these terms in this format. In this statement of income, we start with the sales minus variable cost. It comes in contribution. Contribution, we less the fixed cost. It comes the earning before interest and taxes. In EBIT, we less the interest. We get earning before taxes. We less the tax. We get earning after tax or profit after tax. We again less that preference dividend. We get the earning available for equity shareholders, EAES. We can also derive a formula from formula for earning per share, EPS. EPS comes equal to EPS equal to EAES divided by number of equity shares. This is the formula derived formula for earning per shares. How we find EAES? We find the sales and less the variable cost, contribution came, fixed cost less the EBIT, interest, EBIT came, less interest, EBT came, less tax, and EAT, we less the preference dividend, we get EAES, earning available for equity shareholder. This is, we conclude this statement. You copy down to the notes and you take all notes also. Pause the video and then I conclude the class. Thank you for watching. My voice is so bad. Sorry for that. Next class I start with the leverage analysis. Thank you for watching. And myself Raja Kumar. If you have any doubt, please comment in the comment box. If you have any if you want to contact me, contact at Telegram at CMA Raja Arun Kumar. If you have any future needs, I conducting a MCQ test series, online MCQ test series in my own website. And that cost of per group is I conducted for all group 1 and group 2 for intermediate level. Group 1 and group 2, all 8 subjects, I conducted the MCQ test series only. That compilers are given to you for the MCQ test series. That cost per group is 249 and 449 for both groups. Those who are interested, contact me at Telegram at CMA Rajaramma. Thank you for the opportunity, Pradeep sir. Thank you. If you have any doubts, you comment in the comment box or else contact me. Thank you.